Someone comes in at 62 with $1.2 million saved for retirement. On the surface, that looks solid. But when I ask where the money actually sits, the answer is almost always the same. About 80% of it is in a traditional 401k or IRA. And that's really where the conversation starts. Because every dollar in a traditional 401k or IRA is pre-tax, which means a chunk of that balance was never fully theirs to begin with. It's tax they've deferred, and eventually the IRS collects it. At 62, that bill is manageable. They control how much comes out, which years, and what bracket they pay at. But at 75, the IRS stops asking. Required minimum distributions kick in. Social Security is already running. Medicare premiums might already be elevated because of income from a prior year. And every dollar forced out of the 401k stacks on top of everything else that's already happening. What felt totally manageable at 62 can turn into a tax situation nobody saw coming at 78 or 80. So in this video, I want to walk you through this exact case. Someone at 62 with $1.2 million and 80% of it pre-tax who recently retired, wondering what to do about taxes. And I'm not going to hand you a list of strategies. I'm going to show you the specific 10-year window that decides whether if she controls her tax future or if the IRS does for her. If this sounds like your situation and you want help looking at your own numbers, there's a link in the description to have a conversation with me. There's no pressure, no pitch, just a real look at what your tax picture actually looks like over the next 25 years. But first, let me show you how this plays out for Linda. Linda's 62. She just retired out of a career in corporate finance, and for 35 years, she did everything the financial world told her to do. Fund the 401k, get the match, bump your contributions with every raise, and let it compound. And it worked. She's got $1.2 million saved, a paid off home worth around $480,000, and no pension, but she's ready to enjoy what she built. Here's the breakdown. $960,000 sits in a traditional 401k and IRA. $120,000 is in a Roth she started about 10 years ago. $80,000 is in a taxable brokerage account, and she's got $40,000 in cash. Social Security wise, at 62, she's looking at roughly $2,100 a month. If she waits until her full retirement age of 67, and it's closer to $3,000. If she pushes it to 70, and it's around $3,700. Her spending need is about $6,500 a month after tax. When Linda first sat down and looked at all this, she felt pretty good. $1.2 million, a paid off house, a comfortable number to live on. And she asked the question most people ask right about here. How do I make sure I'm not paying more in taxes than I have to? But before I answer that, I want to show her something most people never actually look at. What her taxes look like not this year, but at 75. Because the real tax problem Linda's facing isn't the one sitting in front of her today. Let's look at Linda's taxes right now at 62. If she just retires and does nothing strategic, she needs $6,500 a month after tax. If she takes Social Security at 62, that's about $2,100 of it covered, leaving roughly $4,400 a month or $53,000 a year that needs to come from her accounts. At this point, that $53,000 is basically her taxable income, plus around $21,000 of Social Security, and roughly 85% of that could count toward her taxable income. If you add it up, and her federal taxable income lands somewhere around $50,000 to $53,000, depending on her deductions. As a single filer, that puts her solidly in the 22% bracket. It's not great, but it's livable. Now fast forward 13 years. At 75, required minimum distributions start. The IRS makes her take a percentage of that pre-tax balance every year, whether she needs it or not. And here's the thing, that $960,000 hasn't been sitting still. Even at a fairly modest growth rate over 13 years, it could realistically grow into something like $1.7 to $1.8 million depending on the market. That's just a general illustration to shape the problem. The first-year RMD on a balance that size isn't small. She could be forced to pull $55,000 to $65,000 out that first year alone. And it's not because she wants to, it's because the IRS says so. Now, stack that on top of 13 years of Social Security. Combined, Her RMD and her benefit could push her well into the 22% bracket, maybe even the 24%. At that level, up to 85% of her Social Security becomes taxable. And if her income crosses certain thresholds, her Medicare Part B premiums could run meaningfully higher than the standard rate, a surcharge she'd be paying not because she did anything wrong, but because her income 2 years earlier was too high. What makes this frustrating is Linda didn't intentionally grow her wealth between 62 and 75. She's enjoying retirement and spending her savings down as best she can. But because the pre-tax balance kept growing in the background, the IRS's claim on it kept growing right along with it. She saved the right way for 35 years. She enjoyed 13 years of retirement. She just never built an exit plan for it. At 62, she still has time to build one. At 75, most of that control is gone. The window before 75 is really the last shot Linda has to reshape this before RMDs shut the door. Most people miss tax planning in retirement. At 62, Linda isn't just managing this year's taxes. Every decision from now until 75 either reshapes her tax picture for the next 25 years or hands that job to the IRS. The stretch from 62 to 72 isn't just time passing. It's the last window where Linda can actually get to choose how much comes out of the pre-tax accounts, which years carry more income, and which bracket she pays. RMDs don't technically force her hand until 75, but the window that actually matters closes earlier than that because the cheapest years to move this money are the years before Social Security turns on. Once that income starts, it stacks on top of everything else for the rest of her life. So her real working room runs from 62 to whenever she claims, and for Linda, that's roughly 10 years. Some might say, well, why not just let her keep it growing? And sure, it is growing. But here's what that growth actually means. Every dollar that pre-tax balance adds is a dollar the IRS has a future claim on. It's not growing into Linda's money, it's growing into a bigger future tax bill. If you take that balance from $960,000 to $1.5 million and the forced distributions down the road get bigger too, which means more income in years she may not even need it, which means higher brackets, more of her Social Security taxed, and possibly higher Medicare premiums. The pre-tax account did its job for 35 years. It built wealth tax deferred. But now Linda needs to do something different. She needs the money coming out on her terms at a pace that doesn't turn into a forced problem a decade from now. And the years from 62 to 72 are likely the lowest income years she'll have in retirement. There's no salary, small or no Social Security if she's delaying, and there's no RMDs yet. Those are the cheapest years to pay this tax. And every year she waits, the window shrinks and the balance grows. If you're watching this and starting to realize that your own pre-tax balance is growing into a future tax problem that you haven't actually modeled out, this is exactly the kind of planning that my team and I work through with people. There's a link in the description to book a conversation with us. Now, before Linda decides how much of that window to use, there's one decision that shapes the whole picture. When should she take Social Security? Most people treat this purely as an income question. You claim at 62 and get less forever, or wait and get more forever, but you fund the gap in between yourself. And that's not wrong, it's just incomplete. For someone sitting on 80% pre-tax like Linda, this is also a tax decision. And here's why. The years before Social Security starts are her lowest income years. If she waits until 67, the stretch from 62 to 66 has zero Social Security income. So the only taxable income she has is whatever she chooses to pull from her own accounts. She could take $40,000 or $55,000 or $65,000. It's her call. And that flexibility matters because it lets her fill her bracket right up to the top without spilling over. Compare that to claiming at 62. That $2,100 a month, which is about $25,000 a year, is coming in whether she wants it or not. And it's already taking up room in her bracket before she's touched a single account. That's roughly $25,000 less room that she has for conversions or withdrawals at a lower rate. Now, claiming early isn't wrong, and there are plenty of situations where it's the right call. But for Linda, whose real challenge is moving a large pre-tax balance through this window at a low rate, turning Social Security on early is a bit like opening one faucet before she's finished filling the other buckets. It eats up room she'd rather use elsewhere. Delaying gives her more runway, more years of income she actually controls, more room to convert from pre-tax to Roth while rates are favorable, and at the end of that wait, she's looking at a meaningfully larger monthly benefit for the rest of her life. That matters even more because she's single and there's no second benefit backing her up. Her floor is her floor. Now that Linda's decided to delay, she's got a runway. The question is, how is she actually going to use it? Here's the constraint that most people don't see coming until they already are in the middle of it. Between 62 and 65, Linda needs private health insurance. She's not on Medicare yet, and what that coverage costs her depends on her income. If she buys through the ACA marketplace, her premium is tied to her modified adjusted gross income for the year. If she stays under a certain threshold, she may qualify for a real subsidy, but if she crosses it, and she could lose a good chunk of that subsidy. The exact number depends on the year, her state, and her plan, so this is just a planning consideration worth reviewing with a tax professional. But it creates a real ceiling on how much she can convert to Roth in any given year before 65. Say her living expenses need $45,000 from the portfolio this year, and the subsidy threshold she wants to stay under is roughly $65,000. That gives her about $20,000 of room. If she converts $20,000 on top of the $45,000 withdrawal, she's right at $65,000, her subsidy's intact, and she's just moved $20,000 from pre-tax to tax-free. But if she pushes it to $50,000 instead, and her income jumps to $95,000, she likely loses much of that subsidy. Her healthcare costs jump, and the tax savings from converting could get eaten right back up by higher premiums. So the ACA constraint isn't really an obstacle, it's more of a guide. It tells her exactly how much room she has each year. Once Medicare starts at 65, that particular constraint goes away, but a new one shows up. Medicare premiums aren't flat for everyone. They're based on income from 2 years earlier, something called IRMA. If Linda's income in 1 year runs above certain thresholds, her premiums for Medicare 2 years later will come in higher than standard. It's the same principle though. She can convert up to the ceiling, just not past it, which is really the whole point. I wouldn't treat Roth conversions as a once-a-year decision. For Linda, it's a 10-year decision. Each year has its own ceiling based on her income, her health coverage situation, and her bracket, and she converts up to that line each year. Over 10 years, that reshapes the whole picture. So what does that 10-year picture actually look like compared to doing nothing? Linda isn't going to avoid paying taxes on this money, and nobody does. And that was never really the question. The question is whether she decides when it gets taxed, at what rate, and in which years, or whether the IRS decides that for her at 75. From 62 to 72, that decision is hers. But once that window closes, it belongs to the IRS, and the RMDs at 75 are just confirmation of that. The window's going to close either way, whether she uses it or not. That pre-tax balance isn't waiting around patiently. It's growing, and every dollar it grows is a dollar the IRS eventually pulls out on its own schedule. So the real answer to how do I minimize taxes is pretty simple. Start deciding now, because in 10 years, that choice isn't hers to make anymore. So that's how I would think through Linda's situation. The next question is really how to track all of this year to year, because this whole window only works if you know where you stand before you make a move. I made a video right here about exactly that. One habit, about an hour a year, that makes every one of these decisions clearer. Roth conversions, distributions, Social Security timing, Medicare thresholds. Without it, most people are making these calls blind. That one's right here, and I'll see you there.